International investors sell the US dollar and US Treasury bonds after Moodys downgraded the US sovereign credit rating. The UK does a trade deal with the EU. The wealth effect from China's property market slump is still dragging on consumption. The RBA is expected to cut by 25 basis points today, but be cautious about cutting more. And Thailand's GDP is stronger than expected, but the numbers flattered to deceive. That's coming up in our 5 Things in 5 Minutes on Tuesday, May the 20th. And then, in our deep dive interview, ANZ's Group Chief Economist Richard Yetsenga takes stock of the latest tariff moves.
So calculating the average tariff rate, important but difficult. We think it's about 18%, which is the highest in a century, but the US economy is 2.5 to 3 times more import intensive than it was a century ago.
But first, in 5 and 5 with ANZ, the US dollar and US Treasury prices sold off overnight after Moodys downgraded the United States' credit rating. That pushed up the Aussie and Kiwi dollars. It's all about concerns about the US budget deficit, says ANZ economist in London, Bansi Madhavani.
The concerns about US's fiscal deficit, we think, will take center stage in coming weeks. House Speaker Mike Johnson had said that he intends to bring the bill to vote on Memorial Day, which is less than a week away.
As of 4 a.m. Sydney-Melbourne time, the S&P 500 and NASDAQ were down around 0.3%, the US dollar index was down 0.6%, and US Treasury prices fell, which meant the yield on the US 10-year Treasury rose 4 basis points to 4.48%. The Aussie dollar rose 0.7% to 64.48 US cents, and the Kiwi rose 0.6% to 59.18 US cents. Gold was up 1.4% at $3,231 an ounce, and West Texas Intermediate futures rose 0.4% to $62.20 US a barrel. Number 2. The UK signed a new trade deal overnight with the European Union, with which it does 50% of its goods trade and 40% of its services trade. But the wins aren't that great for Britain, as Bunzi reports.
However, official estimates suggest that the gains from this deal are likely to be modest. The UK government expects that the UK-EU trade deal will add £9 billion to the UK GDP by 2040, which is just 0.3% of UK's 2024 GDP number. We therefore think that UK's growth prospects will not get any meaningful boost from this trade deal.
Number 3. The Reserve Bank of Australia is expected to cut its cash rate by 25 basis points later today to 3.85%. But it will be cautious about suggesting a lot more rate cuts, says ANZ's Head of Australian Economics, Adam Boyton.
Our thinking this year is that we get a rate cut later today from the RBA. We get another rate cut, 25 basis points again from the RBA in August, and then the bank's on hold for a little while, but more likely than not comes back in early 2026 with a final 25 basis point rate cut at the February meeting.
Number 4. China reported weaker than expected retail sales growth yesterday, which ANZ's chief economist for Greater China, Raymond Yung, says is due in part to the wealth effects of China's property slump. There's only so much the government can do to stimulate spending, with property prices still well below their peaks.
So with this downturn of the property market, it's hard for me to believe that the consumption can hold up, even though the Chinese government want to boost consumption to offset some of the impact of trade. But because of the property slowdown or even contraction, it is hard for us to be optimistic about the consumption outlook. That cannot be boosted by subsidy. That cannot be boosted by those one-off replacement campaign that support the mobile phone sales, refrigerator, and all these things. People will not change mobile phone every month.
Number 5. Thailand reported better than expected GDP growth in the March quarter of 0.7%. But ANZ Asia economist Crystal Tan says the number looked better than it actually was.
The growth was mainly driven by a strong rise in goods exports, and that helped mask subdued domestic demand. Now, importantly, this export momentum appears to be driven by front-loading and won't last. US tariffs rose in April, and their negative impact is expected to filter through in the coming quarters. And in the interim, uncertainty is already starting to stall investment. Now, the lack of other growth drivers will only make things worse. Tourism is usually a key growth pillar in Thailand, but that's now faltering. Preliminary data show that daily arrivals dropped 7.6% year-on-year in April. Now, add to that high household debt and also falling consumer confidence, domestic picture looks pretty fragile.
Crystal Tan there. Now, in today's deep dive interview, ANZ's Group Chief Economist, Richard Yetsenga, takes stock of the latest tariff moves, with 30% tariffs on China instead of 145%. But he says it's still damaging. I asked him to put the current tariff levels into an historical context.
This average tariff rate number is pretty important, but also devilishly difficult to calculate because, of course, part of these deals that Trump is doing is taking us away from the broad principle of a most favoured nation status, which has been a principle in trade for more than 60 years, which is whichever economy you offer the lowest tariff rate for a product to, you should offer that to everybody, so there's a level playing field. And there's also moving away from the in-principle idea that the simplest tariff regime is the best. But, of course, the Trump administration wants all sorts of individual by-country deals and all sorts of carve-outs for different products and all sorts of exemptions for domestic industries. So calculating the average tariff rate, important but difficult. We think it's about 18%, which is the highest in a century, but the US economy is 2.5 to 3 times more import-intensive than it was a century ago. So make no mistake, this is still a shock relative to where we were on the 1st of April. We're still likely to see some pretty discrete shifts in trading patterns. What it does do, though, is move us away from this idea that a US recession is a certainty and the global economy, well, maybe a recession wasn't a certainty, but a very nasty downturn. We've stepped away from that.
However, Trump's grand plan was that the US dollar would rise to soften that impact. That hasn't happened, though, so what do we see now for the United States?
Before Trump had established, or before the Trump presidency had appointed all people into all the key positions, Steve Moran, the chair of the Council of Economic Advisors, while he was at a hedge fund, wrote quite a long piece, 30-odd pages, about kind of remaking the global trading system. One of the fulcrums of his policy recommendations was this conclusion that, conclusion's the wrong term. His working hypothesis was that the dollar would appreciate in response to tariffs like it did in 2018, and the consequence would be the cost for the US would be minimised and actually tariffs would be paid by the other party. Of course, this time the dollar's down 7%, or so it's compounded the effect of the tariffs rather than moving against it.
So we know the tariffs aren't going to fill the shortfalls in revenue. What does that mean for the US's reserve currency status?
Well, of course, we're recording this after Moodys downgraded the US from AAA following the other two rating agencies, S&P and Fitch, who over the last decade progressively have shifted the US away from AAA. I don't think we needed that to tell us the US has a fiscal challenge which is now a focus for markets, but it's just going to exacerbate that. If we take the example of the UK, who had its mini crisis about 2.5 years ago, where the fiscal situation became a real market issue, and actually there were some intersections with the pension system which made it, there was some worrying days and weeks there. The UK continually needs to look at the bond market response when it thinks about how to set its fiscal stance. The US hasn't had to do that to this point. I think we're now into territory where the US will have to really think about the market impact of what it announces on the fiscal side, and there's going to be a lot of pressure to announce policy which is viewed as fiscally credible by the bond market. I mean, the evidence of other economies is once this kind of bond market genie's out of the bottle, it's very difficult to get it back in.
So if we see a longer-term depreciation in the US dollar, how's that going to affect Asian currencies? Because often they have fallen in the past, which has helped their export sectors.
There's a couple of reasons the dollar's relationship with market stress is likely to be different. The first one is the US is a net oil exporter, so it is a bit more commodity correlated. Of course, when the US was an oil importer, periods of stress used to help the US economy because of lower oil prices. Now they hurt the US economy through the trade side. So the dollar's take on a bit of that commodity type characteristic. The second issue, I think there are some genuine questions about the US as a reserve currency because of this fiscal issue. I mean, I'm not confident enough to say, yes, we have started the process of the US ending its reign as the reserve currency. That discussion has been had too many times in my career, but certainly we can say it's a reasonable question to ask and it's a reasonable discussion to have. And on that basis, the dollar being at its highest level in 40 years just doesn't seem quite right, particularly when you consider that what we seem to have learnt in the first 6 months of the Trump presidency is the policy process is likely to be disruptive. It's not the policy process that markets are typically used to. Policies often announced quite abruptly without a lot of preliminary consultation. Implementation issues seem to be pushed to the background or not considered all that deeply. And of course, policy tends to change for one reason or another, and tariffs are a perfect example of that. So I think there's some structural factors here, but also some good cyclical factors. The dollar near the highest level in 40 years doesn't seem quite right.
Richard Yetsenga there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, May the 20th. Catch you tomorrow with the detail and analysis from the RBA's decision later today. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.